Good afternoon, everybody. Going to go over our Forex trades for today, January 30th, the last trading day of the month. This was the first down day we had trading, unfortunately, and have to head into the weekend with a loss. But, that's the way it goes sometimes. It was a slow last 2 weeks of January for several reasons. Obviously, you had the Fed meeting in there, you had the winter storm, one or two other events and economic numbers we had to avoid. We did have two trades today, lost a total of 14.9 pips, and we'll go over them in a minute. Economic data, GDP numbers came out this morning that missed estimates miserably. Several factors to why GDP missed for the fourth quarter. We're reading everything from Obamacare, insurance hitting consumers. And actually seeing a graphic, it is a tremendous burden. It's the number one burden on consumers, actually. What else? But the oil's been coming down, so that's been helping at the pump. So that's a positive. Although the apparently the Obamacare spending is more than you're saving at the pump, a lot more. What else was in there? Just like I said, a whole bunch of factors. Why GDP? Inventory buildup. Not that I guess that is part of GDP. Inventory buildup is the highest quarterly buildup since I think it was 2010. One of the quarters in 2010. The biggest buildup of inventory. Obviously, people don't have the money to spend because they're spending more on not just Obamacare. Let's face it. That is a big burden, but they're spending more on food. And even though the Fed says, inflation is whatever, 2% or under 2%, we all know, and we've done these studies and talked about them in the past. Just in the past few years, the price of everyday items, from milk and bread, eggs, you name it, have all gone up. Meats have all gone up, and it's a variety of factors impact the price of those things. One of them was all the QE that the government was doing. The money's going to risk assets, and let's face it, there's a bunch of speculators that trade these different commodities. Whether it's corn, wheat, and whatnot, and these commodities they trade go into products, go into bread and go into whatnot and milk, and they trade dairy. So that's all speculative money that was going into not just stock market, but going into the speculation in commodities, driving prices up. There was a study on gasoline by Goldman Sachs and I forget the other firm, maybe JP Morgan. Some estimates are as high as 2/3 of the price of oil is because of speculators. So obviously it's going to impact it when the speculators are driving the prices up. But it's also going to impact it when the speculators are driving prices down like they are now in oil. Not that they're driving down the price of wheat and whatnot, but oil broke down. If you look at a chart of oil, it broke down, and it's been driving down pretty much ever since it broke down, and it came down hard in about 6 weeks or so. So again, those studies show approximately 2/3. Some studies have it as high as 2/3. Others are 40%, 50%, 35%, whatever the numbers are. My point is the speculators can drive the price of these things up and they can drive them down hard. So when oil was $100, $110, it could have really been as low as $35. But now here oil's all the way down to 40 some odd dollars a barrel. Well, maybe it should really be 50 or 40, 50, 60% higher than where it is. So there's a give and take. Obviously, it hurts on the way up, but it's gonna help on the way down. All right, that's enough of that. Let's get to it. We had the two trades. Like I said, we lost 14.9 pips on half our normal trading volume, which we do every month, the last 4 or 5 days of any month. We always cut our trading size in half, and it actually definitely helped us this month by since it wasn't a very busy month, although we were very profitable. By having it cut in size the last day, getting hit for 14.9 pips doesn't hurt as much as if you're getting hit on 14.9 pips of your normal size. So let's go over them here. Pound to yen. We got short this last night while we were sleeping. This signal went out hours and many hours ahead of time, so you had plenty of time to get into it. We had put, we got hit 177.442. We had put since we were going to sleep even before we got hit. It was a matter of, where do you put your cover? Do you put it somewhere around the figure? Do you take a chance of having it come to the figure and bounce? So we had put it just ahead of it, maybe by a little bit too much, but we put it at 177.15. That's where we got filled. We got out, picked up 29.2 pips, adjusted for size. That's 4.3 pips because we had about 15% of our normal size. And you can see what it did there. It did come to the figure just as we said it might do and bounce, and it bounced, 50 pips. And then it broke it this morning when the GDP numbers came out. So, if you're still short this, or if you didn't do what we did and you were holding, maybe you had your profit target somewhere in here. I think our second profit target under 177 was around 176.65, if I remember correctly, maybe 176.70. So you had a chance to get out there, and obviously you got a chance to get came all the way down close to 176 even, came down to 176.12 or so. So hopefully you did better than we did. We'll take it. It's not the worst thing. This was the trade that hurt us. We had went over this a little bit yesterday, Australian dollar, Canadian dollar. Remember, I don't know if you remember, if you watched the video, but we were saying this was a head and shoulders pattern. This is the left shoulder here. Then you have the head and then the right shoulder, which is a bearish formation if it breaks the neckline, which is down here. We did say, and in our information, we had said here that since the head was so extended with this long tail, it does decrease the odds of this break of a neckline being successful. So with that, we were only willing to risk 127.5 pips rather than 250, 300 pips. Again, 15% of our normal size. So size adjusted, that's 19.2 pips. Well within the realm of what we risk on a scalp trade. A scalp trade will risk 15, 20, 25, up to 30 pips. So right in the realm of it. So, not too bad. Unfortunately, this trade hasn't worked out. If you're still in it, if you didn't take this, if you didn't get stopped out, this thing could very well work out in the end. But we're going to be flat going into this weekend. We really prefer not to hold positions over the weekends if we can. Rather stay in cash. You never know. Some news comes out. You could get gapped one way or the other. And if you gapped, you can't get out, obviously. That's why it's called being gapped. So we'll move on to Sunday evening, Monday. We'll watch the Super Bowl and see what happens there, and we'll be ready to trade. So that's it. We're going to wrap it up. If any signals come out, they'll be coming your way. I doubt it. There's only a few hours left. But, signals could start coming Sunday evening again. So don't have to wait too long. So that's it. We're going to wrap it up. Have a great weekend, and I hope you watch the game. I hope if you have any money on the game, it works out for you. If you're in a pool, an office pool, whatever, hopefully it works out for you guys. So that's it. Good luck trading if you're still trading, and we'll be back Monday, assuming we get some action.